Legal disclaimer. The content presented in this video and the accompanying series is strictly for educational, informational, and entertainment purposes only. It does not constitute financial, investment, legal, or tax advice. Foreign exchange Forex. Trading carries a high level of risk and may not be suitable for all investors. The high degree of leverage available in Forex trading can work against you as well as for you. Before deciding to trade foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. The possibility exists that you could sustain a loss of some or all of your initial investment, and therefore you should not invest money that you cannot afford to lose. Any examples, historical data, or case studies mentioned are for illustrative purposes only and do not indicate or guarantee future performance. Markets are volatile and subject to rapid changes. We strongly recommend that you conduct your own due diligence and consult with a qualified, independent financial advisor before making any investment decisions. The creators of this content assume no responsibility or liability for any trading losses or damages incurred as a result of reliance on the information provided herein. Imagine standing on the edge of a cliff, staring down into a roaring ocean. That ocean is the foreign exchange market. It is deep, it is dark, and it moves with the force of $7.5 trillion every single day. That is not a metaphor. The Bank for International Settlements reports that the daily turnover in global Forex markets exceeds $7 trillion. To put that into perspective, that is significantly larger than the New York Stock Exchange and the Nasdaq combined. It is the largest, most liquid financial market in human history. Yet, despite this ocean of liquidity, despite the endless opportunity that theoretically exists in every pip of movement, there is a statistic that the brokerage industry rarely puts on their billboards. It is known in professional circles as the 99th percentile reality. While numbers fluctuate, industry data and regulatory disclosures from major financial jurisdictions consistently suggest that a staggering majority of retail traders, estimated often between 70 to 90%, lose money over the long term. Most of them do not just lose a little, they lose everything in their account, often within the first 90 days of opening it. Why does this happen? Why do intelligent people, successful doctors, engineers, and entrepreneurs step into this arena and get decimated? Is the market rigged? Is it impossible? Or are they simply playing a game they do not understand, against opponents they cannot see? The answer lies in a single, missing component. It is the difference between gambling and business. It is the difference between a coin toss and a calculated probability. It is the absence of a true Forex trading strategy. Today, we are not just going to give you a definition. We are launching a comprehensive masterclass that pulls back the curtain on what a professional trading strategy actually looks like. This is not about a magic indicator that tells you when to buy or sell. If you are looking for a get-rich-quick signal service, you are in the wrong place. We are here to solve the specific problem that plagues almost every aspiring trader: the lack of a structured, professional framework. The problem for most is not that they cannot read a chart. It is that they lack a comprehensive business plan for navigating chaos. By the end of this deep dive, you will understand that a strategy is not a line on a chart. It is a complex ecosystem of risk management, psychological discipline, and probabilistic thinking. We are going to dismantle the misconceptions and rebuild your understanding of market engagement from the ground up. Let us begin by defining the battlefield. When you enter a trade without a strategy, you are essentially walking into a casino and putting your entire net worth on black. However, the Forex market is far more ruthless than a casino. In a casino, you know the house edge. In Forex, if you are unprepared, the edge against you is dynamic and aggressive. You are not trading against a static algorithm. You are trading against the collective intelligence of central banks, hedge funds, institutional market makers, and high-frequency trading algorithms that operate in nanoseconds. These entities have a strategy. They have a plan. They know exactly what they will do if the market goes up, if it goes down, or if it goes sideways. Do you? Most novices confuse a trade signal with a strategy. They see a moving average crossover and they click buy. That is not a strategy, that is a trigger. A trigger is a tiny fraction of the equation. A true educational overview of a Forex trading strategy must start with the understanding that it is a complete methodology for decision-making under uncertainty. It is a set of predefined rules that removes emotion from the equation. Let's expand on this concept of removing emotion, because it sounds cliché, but the implications are financial life or death. Neuroscientific studies on financial decision-making show that the pain of a financial loss is processed in the same part of the brain as physical pain. When a trader without a strategy sees a trade going negative, their amygdala, the fear center of the brain, hijacks their logical processing. They freeze. They hope the market will turn back around. They hold on to losing trades, praying for a reversal that never comes, until their account is liquidated. Conversely, when they see a small profit, they panic and close the trade too early, terrified that the market will take it back. This is simple human psychology, and it is the primary reason for failure. A strategy is the psychological guardrail that prevents this. It acts as an external contract you sign with yourself before the market opens. A professional strategy is comprised of 3 non-negotiable pillars, which we will dissect throughout this series. The first is the edge. This is the technical or fundamental reason for entering the trade. It is a scenario where, based on historical data and backtesting, the probability of one outcome is slightly higher than the other. Notice the word slightly. Professional traders do not look for certainty. They look for a statistical advantage. If you have a strategy that wins 55% of the time, and your winners are larger than your losers, you have a license to generate potential returns over a large sample size. The second pillar is risk management. This is often the most boring part for new traders, but it is the only reason professional funds survive for decades. A strategy dictates exactly how much capital is at risk per trade. It defines the position size based on the volatility of the currency pair. For example, trading the British pound against the Japanese yen requires a completely different risk profile than trading the euro against the Swiss franc. A strategy answers the question, if I am wrong, how much will I lose? Before it ever asks, how much will I make? If your strategy does not prioritize capital preservation, it is not a strategy. It is a liability. The third pillar is trade management and psychology. This defines what you do after the entry. Do you move your stop loss to break even? Do you scale out of the position? Do you hold through news events like the non-farm payrolls? A strategy provides a rigid flowchart for these decisions, so that you are never making a choice in the heat of the moment, when your pulse is racing, and your judgment is clouded by fear or greed. Let's look at a hypothetical case study to illustrate the difference. Trader A looks at a chart, sees the price of gold dropping, and feels like it has gone too low. He buys, risking 20% of his account, because he wants to make back the money he lost yesterday. The price drops further. He doubles down. The price crashes. He is wiped out. This is emotional impulse trading. Now consider Trader B. She is following a trend-following strategy. Her rules state she only buys when the price is above the 200-day moving average. Currently, the price is below it. She does nothing. She sits on her hands. Her strategy has saved her from a loss. Later, she identifies a setup that aligns with her rules. A pullback to support in an uptrend. She calculates her position size so that if she is wrong, she loses only 1% of her capital. She enters the trade. The market moves against her, hitting her stop loss. She exits immediately, losing 1%. She records the loss in her journal and waits for the next setup. Trader B is operating a business. Trader A is gambling. Over the course of 100 trades, Trader A will likely be bankrupt, while Trader B, even with a 50% win rate, will potentially be profitable because her losses are contained and her winners are allowed to run. This deep dive is about transforming you from Trader A to Trader B. It is about shifting your mindset from guessing to executing. We are going to explore the nuances of technical analysis, fundamental analysis, and sentiment analysis, not as separate entities, but as components of a cohesive strategic engine. We will look at how historical trends in the Eurozone impact currency valuation, and how a strategy incorporates interest rate differentials between the Federal Reserve and the European Central Bank. We must also address the concept of expectancy. In the world of professional trading, a strategy is mathematically defined by its expectancy. This is the average amount you can expect to win or lose per dollar at risk. Developing a strategy involves rigorous testing. You cannot simply wake up, decide to trade, and call it a strategy. It requires looking at past data, tens of thousands of candles on a chart, and verifying that your edge actually exists. We will discuss how professionals use backtesting software to simulate years of trading in minutes, verifying the viability of a strategy before risking a single cent of real capital. Furthermore, we need to understand that no single strategy works in all market conditions. The market cycles between trending states, ranging states, and high volatility breakout states. A strategy that prints money during a strong trend might bleed capital during a choppy sideways market. Therefore, a comprehensive answer to what is a Forex trading strategy must include the ability to identify the market regime. It is knowing when not to trade. Some of the best traders in the world spend more time on the sidelines than they do in the market. Their strategy dictates patience. It dictates that cash is also a position. As we embark on this 10-part masterclass, we are going to build this structure brick by brick. We are going to move beyond the surface-level advice found on social media forums and delve into the mechanics of institutional order flow. We will examine why support and resistance levels work, not because lines on a chart are magic, but because they represent aggregated zones of supply and demand where major market participants have placed billions of dollars in orders. Your strategy is your map through these zones. But a map is only useful if you know exactly what you are looking for, and more importantly, if you understand the probability of finding it. This brings us to the first and arguably the most intellectually challenging pillar of a professional Forex trading strategy: the mathematical edge. To understand the edge, we must strip away the facade of Wall Street sophistication and look at the raw mechanics of probability. Imagine for a moment that you own a casino. You walk across the plush carpet, past the slot machines to the roulette table. You watch a gambler put $1,000 on red. The wheel spins. The ball bounces. It lands on black. The house wins. The next spin, he bets on red again. It lands on red. He wins. To the untrained eye, this looks like a battle of luck. But as the casino owner, you are not gambling. You are executing a business plan based on the law of large numbers. You know that because of the green zero, and sometimes the double zero, on that wheel, the odds are permanently tilted in your favor by approximately 2.7% to 5.26%. You do not care about the outcome of 1 spin or 10 spins or even 100 spins. You care about the outcome of 1 million spins. Over 1 million spins, that slight statistical advantage guarantees that wealth transfers from the players to the house. In Forex trading, your primary objective is to stop thinking like the player and start thinking like the casino. A trading strategy is simply the methodology you use to identify scenarios where the probability of a specific outcome is greater than 50%. You are searching for your own green zero in the chaotic data of currency fluctuations. Let's deepen this concept with a concrete example of a technical edge. Imagine you are looking at a chart of the euro to US dollar pair. You notice that for the past 3 weeks, every time the price hits 1.0800, it bounces back down. This is a resistance level. Why does this happen? It is not magic lines. It is because at 1.0800, there is a massive aggregation of sell orders from institutional exporters, hedge funds, and central banks who believe the euro is overpriced at that level. Now, imagine the price suddenly surges through 1.0800 with high volume. The resistance is broken. Here is where the novice chases the price, buying at the top because of FOMO, or fear of missing out. The professional strategist, however, waits. They know that historically, broken resistance often turns into support. They wait for the price to come back down to 1.0800. Why? Because the traders who sold at 1.0800 are now losing money. As the price comes back to their entry point, they exit their losing trades to break even. To exit a sell trade, you must buy. This wave of buying pressure, combined with new buyers entering the market, creates a floor. This setup, the break and retest, is a classic technical edge. It does not work every time, but historical analysis might suggest it works 60% of the time. If you take this trade 1,000 times, and you manage your risk correctly, the math suggests you will be profitable. You have identified a glitch in the matrix where the odds are tipped in your favor. But an edge is not solely technical. Let's explore the fundamental edge, which drives the massive multi-year trends we see in the global economy. Consider the concept of the carry trade. This is one of the oldest and most robust strategies in the history of finance. Imagine a scenario where the Federal Reserve in the United States has set interest rates at 5% to combat inflation, while the Bank of Japan has kept interest rates at negative 0.1% to stimulate growth. This creates a massive divergence. In this environment, a large institutional fund can borrow money in Japanese yen, paying almost no interest, and use that money to buy US Treasury bonds or US dollar assets that yield 5%. They are essentially getting paid to hold the trade. This creates a consistent, relentless demand for US dollars and a selling pressure on the Japanese yen. A trader understanding this fundamental reality has a directional bias. They know that the path of least resistance, For the US dollar to Japanese yen pair is up. They are not just guessing. They are aligning themselves with the flow of global capital. Even if the chart looks messy on a 5-minute time frame, the macroeconomic gravity is pulling the pair in a specific direction. That is a fundamental edge. However, identifying the edge is only half the battle. We must quantify it. This brings us to the most important equation in trading, one that is absent from almost every amateur's plan: the expectancy formula. Write this down in your mind. Expectancy equals winning percentage multiplied by average win size minus losing percentage multiplied by average loss size. Let's run a simulation. Imagine Trader X. He has a strategy that wins 90% of the time. Sounds incredible. He feels like a genius. But when he wins, he snatches a tiny profit of $10. When he loses, which only happens 10% of the time, he refuses to close the trade and eventually takes a massive loss of $200. Let's do the math. 0.90 times 10 minus 0.10 times 200. That is 9 minus 20. The result is negative 11. Despite being right 90% of the time, Trader X has a negative expectancy. He will eventually lose all his capital. He is a winner in terms of accuracy but a loser in terms of profitability. Now contrast this with Trader Y. Her strategy is trend following, which is notoriously difficult psychologically because it often has a low win rate. She only wins 40% of her trades. She is wrong more often than she is right. However, her strategy dictates that she cuts losses instantly and lets winners run. Her average win is $300, and her average loss is $100. Let's run the expectancy. 0.40 times 300 minus 0.60 times 100. That is 120 minus 60. The result is positive 60. Every time she takes a trade, statistically, she is making $60, even though she loses the majority of the time. This reveals the paradox of the Forex trading strategy. You do not need to predict the future to be profitable. You need to execute a mathematical formula over a large sample size. This is why professionals speak in terms of R multiples, how much reward they get for every unit of risk. Trader Y is looking for a 3R trade, risking 1 to make 3. Trader X is trading a negative R multiple. But here is the dangerous trap that catches even those who understand the math. It is called the distribution of outcomes. Even with a strategy that has a 60% win rate, probability dictates that wins and losses do not come in a neat alternating pattern. You do not get win-loss. You might experience a cluster of 8 wins in a row, making you feel invincible. But equally probable is a cluster of 8 losses in a row. This is known as a drawdown. Every single strategy, no matter how professional, no matter if it is used by Goldman Sachs or a retail trader in a basement, goes through periods of drawdown. Imagine sitting at your screen for 2 weeks straight. You execute your strategy perfectly. You follow every rule. And you lose 8 times in a row. Your account balance is dipping. Your confidence is shattered. You start to doubt if the edge even exists. You start to think the market has changed. This is the breaking point. This is where 90% of traders quit or worse, abandon their strategy to try something new, resetting the cycle of failure. They do not realize that the drawdown is a statistical necessity, a toll you must pay to play the game. The edge is only valid over the long term, but you have to survive the short term to realize it. How do you survive that cluster of losses without going broke? How do you ensure that 8 losses in a row simply dents your fender rather than totaling your car? The answer lies in the second pillar, the shield that protects the sword of your edge. Without this next component, having a winning strategy is mathematically irrelevant because you will be bankrupt before the probability plays out. Most people think they understand this next concept, but they apply it incorrectly. They think it's just about placing a stop loss. But true professional protection goes far deeper into the mechanics of position sizing and correlation exposure. What happens when you think you are diversified, but you are actually betting your entire account on one outcome without knowing it? This is the silent killer of trading accounts. It is called correlation exposure, and it is the reason why a trader can feel diversified while standing on a trapdoor. Imagine you analyze the markets and find 3 separate setups. You decide to buy the euro against the US dollar because the European data looks strong. You also decide to buy the British pound against the US dollar because the UK technicals show a breakout. Finally, you buy gold, which is priced in US dollars because inflation metrics are rising. You place 3 separate trades, risking 2% of your account on each. You pat yourself on the back for splitting your risk across 3 different assets. In your mind, you have 3 independent chances to win. But if you look at the underlying mechanics, you have essentially placed one massive bet. You are shorting the US dollar 3 times. The euro, the pound, and gold often have a high positive correlation against the greenback. If the US dollar index spikes up due to a surprise Federal Reserve announcement, the euro drops, the pound drops, and gold drops. You do not lose 2% 3 times, you lose 6% in a single heartbeat. You were not diversified, you were leveraged on a single outcome. A professional strategy includes a correlation matrix check. It dictates that if you have exposure to the US dollar in one trade, you must either reduce your risk on subsequent USD-related trades or avoid them entirely to prevent catastrophic systemic failure. Now, let's move to the mechanical core of the shield, position sizing. This is the single most critical technical skill in a trader's arsenal, yet it is the one most frequently ignored by novices who are obsessed with entries. Ask a novice how much they trade and they will say, "I trade one standard lot." This is a nonsensical statement. Trading a fixed lot size regardless of the setup is like a doctor prescribing the same dosage of medication to an elephant and a mouse. A professional strategy uses dynamic position sizing based on volatility. Let's walk through the math, because this calculation is what separates the solvent from the bankrupt. The formula for position sizing is position size equals stop-loss distance times pip value, account balance times risk percentage. Let's apply this to a case study involving a $10,000 account. Our sophisticated trader, let's call her Sarah, has a strict rule. She never risks more than 1% of her capital on a single trade idea. This means her risk amount is fixed at $100. Scenario A. Sarah sees a trade on the Australian dollar to US dollar. The market is calm. Her technical analysis tells her that her invalidation point, her stop loss, needs to be 20 pips away from her entry. She calculates $100 divided by 20 pips. This allows her to trade a larger lot size because the stop is tight. She is risking $100 to potentially make $300. Scenario B. Sarah looks at the pound sterling to Japanese yen. This pair is nicknamed the Widowmaker because of its extreme volatility. The market is thrashing wildly. To stay safe, her stop loss needs to be much wider, let's say 100 pips away, to avoid getting stopped out by random noise. Now she calculates $100 divided by 100 pips. Her position size must be 5 times smaller than in scenario A. Here is the magic. In both scenarios, if she hits her stop loss, she loses exactly $100. Whether the market moves 20 pips or 100 pips against her, the damage to her account is identical and mathematically contained. She has neutralized volatility. The novice, trading a fixed lot in scenario B, would have lost 5 times as much simply because the pair was more volatile. Sarah's strategy normalizes risk. The novice's strategy is at the mercy of market variance. This leads us to the concept of drawdown tolerance and the mathematics of recovery. Why do we harp on the 1% or 2% risk rule? Why not risk 10% if you are confident? The answer lies in the asymmetric nature of percentage losses. If you risk 10% per trade and you lose, and remember, a losing streak of 5 or 6 trades is statistically probable even in great strategies, you have lost roughly 40 to 50% of your account. Now look at the recovery math. If you lose 50% of your account, you do not need a 50% gain to get back to break-even. You need a 100% gain. You have to double your money just to get back to where you started. This puts immense psychological pressure on the trader, forcing them to take bad trades to make it back. However, if you risk 1% and lose 5 trades in a row, you are down roughly 5%. To recover a 5% loss, you need a gain of approximately 5.3%. That is manageable. That is just 1 or 2 good trades. A professional strategy is designed to keep you in the easy recovery zone. It prioritizes survival over home runs. Case studies of long-term successful hedge funds show that their primary obsession is capital preservation. As the famous investor George Soros said, "It's not whether you're right or wrong, but how much money you make when you're right and how much you lose when you're wrong." We must also address the tool that amplifies all of this, leverage. In the United States, Forex brokers might offer leverage of 50 to 1. Offshore, it can go up to 500 to 1. Novices view leverage as a way to turn $100 into $1 million. Professionals view leverage as a tool for efficiency, but they respect it as a weapon. Imagine driving a Formula One car. Leverage is the engine. It allows you to travel at 200 miles per hour. If you are a professional driver, Trader B, with a strategy, a map, and protective gear, you can use that speed to win the race. But if you are a learner driver, Trader A, with no strategy, pressing the accelerator to the floor ensures only one outcome: a high-speed crash. Leverage does not change the quality of the trade. It simply accelerates the realization of the outcome. If you have a negative expectancy strategy, as discussed in Part 2, leverage will simply bankrupt you faster. It essentially removes the buffer of time you have to learn. A strategy with high leverage and poor risk management is not a strategy. It is financial suicide with a turbocharger. Let's synthesize these elements. A robust risk management strategy includes a maximum risk per trade, e.g. 1%, a maximum correlation exposure, e.g. never more than 3% risk on open USD positions, a daily loss limit, e.g. if I lose 3% in a single day, I stop trading for 24 hours, a drawdown protocol, e.g. if I lose 10% of my account total, I have my risk per trade until confidence is restored. This is the infrastructure of a business. It is boring, it is rigid, and it is the only thing that stands between you and the 99% of traders who fail. But let's assume you have mastered this. You have the edge, the sword. You have the risk management, the shield. You sit down at your desk. The setup appears. The math says buy. The risk is calculated. Everything is perfect. But then your heart starts pounding. Your palms get sweaty. You hesitate. You remember the last loss. You watch the price tick up without you. Or you enter the trade, and as soon as it goes 1 pip in profit, you have an overwhelming urge to close it to bank the green, violating your strategy. You are about to discover that the greatest enemy in the Forex market is not the central banks, not the hedge funds, and not the algorithms. It is the 3 pounds of gray matter inside your own skull. The best strategy on paper is worthless if the operator malfunctions under pressure. How do professional traders rewire their brains to execute like machines when thousands of dollars are fluctuating in front of their eyes? We are about to open the door to the psychology of execution. This is the unspoken crisis of the financial markets. You can have a Nobel Prize-winning mathematical model, a computer setup worth $10,000, and the fastest data feed in New York, but if your biology is working against you, you are destined to fail. The psychology of execution is not about positive thinking or affirmations. It is about understanding the neurochemistry of risk and hacking your own evolutionary programming. To understand why execution is so difficult, we must look at the human brain. Your brain evolved over millions of years to survive in the savannah, not to trade the chaotic fluctuations of the euro against the dollar. The primitive part of your brain, the amygdala, is responsible for the fight or flight response. Its job is to detect threats. In the ancestral environment, a threat was a predator. In the modern trading environment, the amygdala perceives a loss of capital as a direct threat to your survival. When you are in a trade and the price moves against you, seeing those red numbers flash on your screen triggers the exact same biological stress response as being chased by a lion. Your heart rate increases, cortisol floods your system, and blood is diverted away from your prefrontal cortex, the part of the brain responsible for logic, planning, and rational decision-making. Literally, at the exact moment you need your intelligence the most, you are physiologically becoming less intelligent. You are operating in a hot state. This biological hijacking leads to the most destructive behaviors in trading, primarily driven by a cognitive bias known as loss aversion. This concept, popularized by psychologists Daniel Kahneman and Amos Tversky, suggests that the psychological pain of losing is twice as powerful as the pleasure of gaining. Let's play out a scenario to see how this destroys a strategy. Imagine you have a solid plan. Buy at support, stop loss at 50 pips, take profit at 100 pips. This is a 2-to-1 reward to risk ratio. You enter the trade. Almost immediately, the price drops 20 pips. Your amygdala flares up. You feel physical discomfort. You start bargaining. You think, if I just move my stop loss a little lower, I can give the trade more room to breathe. You move the stop loss to 70 pips. You have just violated your risk management rules. The price drops further. Now you are down 60 pips. The pain is intense. You think, I can't close it now, it has to turn around eventually. You are now in hope mode, which is the death knell of a trader. You hold the bag until your account is decimated. Now reverse the scenario. You enter the trade and the price shoots up 20 pips in your favor. You are in profit. Logic says hold until 100 pips. But your fear center whispers, what if the market takes this profit away? You are terrified of the profit evaporating. So, you close the trade early, banking a tiny 20 pips. This behavior creates an inverted risk profile. You are holding losers hoping they come back, unlimited risk, and cutting winners early out of fear, limited reward. You have turned a profitable strategy into a losing one simply because you could not execute the plan. You surrendered to your biology. Another insidious bias is recency bias. This occurs when a trader gives too much weight to the most recent events. Imagine you followed your strategy perfectly for 3 trades in a row, but all 3 were losses. This is statistically normal. It is just a cluster of bad luck. However, recency bias tells your brain, this strategy doesn't work. Then the 4th setup appears. It is the perfect setup. It matches every criteria of your edge. But you hesitate. You are gun-shy. You stare at the button, paralyzed by the trauma of the last 3 losses. You decide to skip the trade. You watch in horror as the market explodes in the direction you would have bet, hitting your take-profit target without you. The psychological damage of missing a winning trade is often worse than taking a losing one. It leads to revenge trading, where you jump into the market blindly to chase the move you missed, usually right at the top, leading to a catastrophic loss. So, how do professional traders inoculate themselves against these biases? They do not suppress their emotions. They systemize them out of the equation. They bridge the gap between the cold state, planning, and the hot state, execution. The cold state is when you are analyzing the market on the weekend or before the session opens. The market is not moving. You are calm. Your logic is intact. The hot state is when the candles are flying and money is on the line. Professionals make all their decisions in the cold state. They treat the trading session as purely administrative work. This leads to the concept of the checklist. Just like an airline pilot does not rely on memory during an emergency, a professional trader does not rely on intuition during a trade setup. They have a physical or digital checklist that must be ticked off. Is the price above the 200 EMA? Yes/no. Is there a bullish engulfing candle? Yes/no. Is the risk less than 1%? Yes/no. Is there a major news event in the next hour? Yes/no. If any box is unchecked, the trade is invalid. No thinking required. No emotion allowed. It is binary. By forcing the brain to process a checklist, you re-engage the prefrontal cortex and dampen the amygdala's response. You are slowing down the thinking process to prevent impulse actions. Furthermore, elite traders use a technique called set and forget. Once the order is placed, the stop loss and take profit are set in the broker's server. At this point, the professional trader often walks away from the screen. They know that staring at every tick of the price creates a micro-emotional roller coaster that drains willpower. If you sit and watch a 4-hour candle form, you will be tempted to interfere with the trade 1,000 times. By walking away, you are physically preventing yourself from self-sabotage. You are trusting the probabilities you calculated in the cold state. Let's look at a case study of a systematic trader. Imagine a hedge fund trading desk. They do not shout and scream like in the movies. It is quiet. Why? Because they are executing a process. They know that a single trade is statistically insignificant. They are not trying to win this trade. They are trying to execute their edge over the next 1,000 trades. This shift in perspective from outcome-oriented to process-oriented is the holy grail of trading psychology. If you judge your success by whether you made money today, you will be an emotional wreck. If you judge your success by whether you followed your plan perfectly regardless of the monetary outcome, you are building the mindset of a professional. In this paradigm, a losing trade that followed the rules is a good trade. A winning trade that broke the rules is a bad trade, because it reinforces bad habits that will eventually destroy you. We have now constructed the internal engine of the trader. We have the strategy, the edge, the risk management, the shield, and the psychology, the execution. But a Formula One car with a great engine and a skilled driver is useless if you drive it into a swamp. You need a track. You need to know the terrain. You need to understand that not all trading hours are created equal. The Forex market is a 24-hour cycle, but it is not 24 hours of opportunity. There are specific windows of time where liquidity floods the market, creating the volatility we need to make money. And there are dead zones where the market acts like an erratic, choppy mess that eats strategies alive. Furthermore, there is a hierarchy of currency pairs. Some are majestic, flowing rivers of liquidity like the euro to US dollar. Others are exotic, dangerous rapids with massive spreads and slippage. Understanding the where, And the when is just as critical as the how. Most beginners lose money simply because they are trading the wrong pair at the wrong time. They are trying to surf when the ocean is flat. We are about to map the global flow of money, from the sunrise in Tokyo to the closing bell in New York. We are going to dissect the 3 major trading sessions and reveal which pairs belong to which session, and why trading outside of these windows is often a fool's errand. Are you ready to sync your watch with the heartbeat of the global economy? It is a common misconception that because the Forex market is open 24 hours a day, 5 days a week, it is always open for business. This is a fallacy that costs retail traders millions. While it is technically true that you can click a button at any time, liquidity, the lifeblood of price movement, is not constant. It flows around the globe like a tide, following the sun and the opening hours of major financial centers. Trading the euro to US dollar during the quiet Asian lunch hour is like opening a retail store at 3 in the morning. You might make a sale, but you are fighting against the natural rhythm of commerce. To build a professional strategy, you must understand the 3 sessions and the specific personality of each. Let's begin where the trading day theoretically starts. The Asian session. This is often referred to as the Tokyo session. It begins when the liquidity comes online from New Zealand and Australia, Wellington and Sydney, followed by Tokyo, Hong Kong, and Singapore. Historically, this session is characterized by lower volatility compared to its Western counterparts. The major players here are the Japanese exporters and central banks managing reserves. For a trader, the Asian session often represents consolidation. If you are a breakout trader looking for massive 100-pip moves, this session can be a graveyard of false starts. Prices often oscillate within a tight range. However, if your strategy is built on mean reversion, betting that the price will return to an average, the Asian session can be highly effective. Case studies suggest that pairs involving the Japanese yen JPY, Australian dollar AUD, and New Zealand dollar NZD see the most action here. A trader trying to trade the pound sterling to US dollar during Tokyo hours often finds themselves stuck in a chop fest, paying spread costs for zero movement. Then comes the awakening of the giant, the London session. This is the undisputed capital of the Forex world. Historical data indicates that approximately 30 to 40% of all daily Forex transactions pass through London. When the Frankfurt and London banks open, around 2 a.m. to 3 a.m. Eastern Standard Time, volatility spikes dramatically. This is when the real move of the day often begins. Institutional algorithms dormant during the Asian session suddenly wake up. We often see a phenomenon known as the London breakout. This occurs when the price breaks out of the tight range established during the Asian session. A common strategic approach involves identifying the high and low of the Asian range and positioning for a breakout when London volume hits. However, this is also where the fakeout is most prevalent. Smart money often pushes the price in one direction to trigger retail stop losses before reversing the trend for the rest of the day. Understanding this liquidity cycle is crucial. Without it, you are simply guessing. As the London session matures, we approach the most explosive time of the trading day, the New York session, and specifically, the London-New York overlap. This occurs roughly between 8 a.m. and 12 p.m. Eastern Standard Time. During this 4-hour window, the 2 largest financial centers in the world are open simultaneously. European traders are finishing their day, squaring off positions, while American traders are just arriving, reacting to U.S. economic data releases like the CPI or non-farm payrolls. This overlap creates a superstorm of liquidity. For a day trading strategy, this is the golden window. Spreads are typically at their tightest and execution speeds are at their fastest. If a trend is going to happen, probability suggests it will happen here. Conversely, after the London market closes, around 12 p.m. Eastern Standard Time, liquidity in the New York session often dries up. The markets can become lethargic. A trader continuing to push for aggressive entries at 3 p.m. Eastern Standard Time is often fighting a dying trend, exposing themselves to algo churn, where high-frequency bots trade back and forth with no directional bias. But knowing when to trade is only half the equation. You must also know what to trade. This brings us to the hierarchy of currency pairs: majors, minors, crosses, and exotics. A professional strategy restricts its focus to assets that offer the best cost of business. In Forex, your cost of business is the spread, the difference between the buy and sell price, and commission. The major pairs, euro to US dollar, pound sterling to US dollar to Japanese yen, US dollar to Swiss franc, involve the US dollar and the currencies of other major economies. Because these are the most traded, they have the highest liquidity and the lowest spreads. For a beginner or even an intermediate trader, focusing on the majors is a form of risk management. You can enter and exit positions of millions of dollars without significantly moving the market price. Next, we have the minor pairs or crosses, euro to pound sterling, euro to Japanese yen, pound sterling to Japanese yen. These do not involve the US dollar. They often exhibit cleaner technical trends because they are not as heavily manipulated by high-frequency news algorithms centered on the US economy. For instance, the pound sterling to Japanese yen is known as the beast or the dragon because of its massive volatility. A strategy designed for the calm euro to US dollar will be destroyed by the violent swings of the pound sterling to Japanese yen. A trader must calibrate their position sizing, as discussed in Part 3, specifically for the volatility of the crosses. Finally, we have the exotic pairs, US dollar to Mexican peso, USD/TRY/USD/AR. These involve a major currency and a currency from a developing or emerging economy. Novices are often attracted to these because of the high interest rate differentials, swaps, or massive trend movements. However, this is dangerous territory. The spreads on exotics can be 10 to 50 times wider than the majors. You might enter a trade and be immediately down significantly just due to the spread. Furthermore, liquidity can vanish instantly during political instability, leading to gaps where the price jumps past your stop loss, causing you to lose far more than you risked. A robust strategy usually avoids exotics unless the trader has specialized knowledge of that specific economy. Let's imagine a scenario to illustrate the importance of asset selection and timing alignment. Trader A decides to trade the US dollar to Canadian dollar, US dollar versus Canadian dollar. He decides to trade it during the London Open. He watches the chart for 3 hours. Nothing happens. Why? Because the US and Canada are asleep. The banks in Toronto and New York are closed. There is no natural commercial flow for this pair. He gets frustrated, forces a trade, gets stopped out by a tiny random movement, and blames the market. Trader B has a strategy. She knows that the US dollar to Canadian dollar is a North American pair. She waits for the New York Open, specifically 8:30 a.m. Eastern Standard Time when Canadian economic reports are often released. She sees volume spike. The market moves with conviction. She enters on a pullback and captures a 50-pip move in 2 hours. Same pair, different time, completely different outcome. Trader B aligned her asset selection with the appropriate time window. This alignment extends to correlation awareness within sessions. During the London session, if the euro to US dollar is moving up, it is highly probable that the pound sterling to US dollar and Australian dollar to US dollar are also moving up, while the US dollar to Swiss franc is moving down. This is because the US dollar is the counterweight in all these pairs. If the dollar is weak, it is weak everywhere. A strategy that ignores this creates a cluster risk. Imagine buying the euro to US dollar and simultaneously selling the pound sterling to US dollar. You are essentially betting that the euro will go up against the dollar, but the pound will go down against the dollar. While possible, this requires a specific divergence in the European versus British economy. Most of the time, you are just hedging yourself, paying 2 spreads to make 0 profit. So we have defined the rules of engagement. We know the battlefield, the market, the weapons, the edge and risk management, the soldier, the psychology, and the terrain, the sessions and pairs. But how do we actually read the map? How do we look at a blank chart, filled with nothing but green and red bars, and decipher the language of price? How do we distinguish between a trend that is about to continue and a trend that is about to collapse? This is the realm of technical analysis, but not the kind you see in basic textbooks. We need to move beyond head and shoulders patterns and understand the raw mechanics of price action and market structure. Most traders look at a chart and see lines. Professionals look at a chart and see a narrative of war between buyers and sellers. They can pinpoint exactly where the losing traders are trapped and how to exploit their pain. This is the dark art of reading liquidity pools. Are you ready to learn how to see the invisible orders resting on your chart? To the untrained eye, a price chart is a record of where the price has been. To the professional strategist, it is a map of where the money is currently hiding. This brings us to the concept of liquidity pools, the fuel that powers the engine of the Forex market. You must understand a fundamental truth about how markets operate. For every buyer, there must be a seller. This sounds simple, but the implications are profound when we talk about institutional scale. If you are a retail trader sitting in your bedroom and you want to buy one standard lot of euro to US dollar, you click buy, and the broker fills you instantly. Your order is a drop in the ocean. You do not move the price. But imagine you are a large institutional bank, a hedge fund, or a central bank algorithm. You do not want to buy one lot. You want to buy 50,000 lots. You have billions of dollars to deploy. If you click buy at the current market price, there simply aren't enough sellers available at that specific price point to fill your order. Your massive buying pressure would chew through all the available sell orders, driving the price up vertically, known as slippage. By the time your order is filled, you would have pushed the price up against yourself, ruining your average entry price. So what does the smart money do? They need to find a place where there is a massive cluster of sell orders sitting and waiting. They need a pool of liquidity deep enough to absorb their size. And where do millions of retail traders place their sell orders? Right below support, and right above resistance, in the form of stop losses. Remember, if you have bought a currency pair, your stop loss is a sell order. If the price hits your stop, you automatically sell your position to exit. Therefore, a cluster of retail stop losses is essentially a buffet of liquidity for a large institution looking to buy. Let's look at a classic double top scenario to illustrate this brutal mechanic. Retail textbooks teach that a double top is a bearish reversal pattern. You see the price hit a ceiling twice. It looks like a solid wall of resistance. The textbooks say, sell here and place your stop loss just above the highs. Millions of traders follow this advice. They pile in short, placing their stops, which are buy orders, just above that resistance line. The institutional algorithm sees this data. It knows the liquidity is sitting there. Suddenly, the price aggressively spikes up, punching through the resistance level. The retail traders scream, breakout. The breakout traders jump in buying, and the short sellers get stopped out, forced to buy. This creates a massive surge of buy orders. This is exactly what the smart money was waiting for. They use this surge of buy liquidity to sell their massive positions into the market without moving the price against themselves. They are selling while you are buying. Once their orders are filled, the buying pressure evaporates, and the price collapses back down, leaving the retail traders trapped and confused. They call it a fake out. The professional calls it a liquidity grab, or a stop hunt. Your strategy must account for this. You must stop placing your stops where everyone else does, because that is exactly where the market is likely to go before the real move happens. This leads us to the study of market structure, the grammar of the market's language. While indicators like the Relative Strength Index (RSI) or MACD are popular, they suffer from a fatal flaw. They are lagging. They are mathematical derivatives of past price. They tell you what happened 5 minutes ago. Price action tells you what is happening now. A professional strategy relies on reading the flow of market structure. In a bullish trend, the market prints a series of higher highs and higher lows. As long as the price respects the previous higher low, the trend is intact. This is the protected low. The moment price breaks a protected low with conviction, we have a break of structure, BOS, or a change of character, CHOC. This is the earliest possible warning signal that the regime has changed. Let's imagine a change of character scenario. You are watching the pound sterling to US dollar. It has been climbing for 3 days. Every dip has been bought up. The RSI is screaming overbought. But the price keeps rising. The novice keeps selling, trying to pick the top, and keeps getting run over. The strategist waits. They watch the most recent higher low. Let's say at 1.2500. Suddenly, a heavy sell-side candle smashes through 1.2500 and closes below it. This is significant. It tells us that the buyers who were defending that level have been overwhelmed. The structure has shifted from bullish to bearish. The strategist does not sell immediately. They wait for the retest. They wait for price to come back up to the scene of the crime, the level that was broken, to see if it holds as resistance. If it does, they enter short. They are not guessing. They are reacting to a structural confirmation. This approach moves you away from prediction and into reaction. You stop trying to be a fortune teller and start being a hunter. You are stalking the setup. If the setup does not present itself, if the structure does not break, you do nothing. You preserve your capital. Furthermore, we must discuss the concept of imbalance or fair value gaps. When a large institution enters the market with force, they often leave a vacuum in price action. Imagine a massive green candle that has no wick on the bottom. The price moved so fast that there was no efficient transaction between buyers and sellers at those levels. The market hates inefficiency. Historical trends suggest that the price will often return to fill this imbalance later, like a magnet pulling iron. A refined strategy uses these imbalances as targets or entry zones. If you see a break of structure downwards, and there is a massive imbalance left above, you can reasonably expect the price to rally back up to fill that gap before continuing the downward trend. This gives you a precise entry point with a tight stop loss, vastly improving your risk-to-reward ratio. Case studies of smart money concepts, SMC, trading often show traders catching the exact wick of a high or low. They are not lucky. They are identifying the specific order block, the final candle before the institutional move began, and placing their limit orders there. They are betting that the institutions left pending orders at that level and will defend it. However, learning to read market structure and liquidity is complex. It requires screen time. It requires training your eyes to see the narrative behind the bars. And even when you master the technicals, you are faced with another critical decision: the dimension of time. A strategy is not just about where you enter but how long you stay. Are you a speedboat or an oil tanker? Are you looking to extract 5 pips in 2 minutes or 500 pips in 2 months? Your personality, your lifestyle, and your capital resources will dictate your time horizon. Misaligning your strategy with your lifestyle is a recipe for disaster. Imagine a father with a full-time 9-to-5 job trying to be a scalper, glued to the 1-minute chart. He will be stressed, he will miss trades during meetings, and he will make mistakes due to fatigue. Conversely, imagine a hyperactive 20-year-old with a short attention span trying to be a position trader, holding trades for months. He will die of boredom and likely close the trade early just to feel the dopamine hit of action. We need to categorize the 4 distinct tribes of Forex traders. Each tribe has its own rules, its own charts, and its own unique strategic requirements. You need to identify which tribe you belong to before you place your next trade. Because if you try to speak the language of a scalper while trading the time frame of a swing trader, you are going to get lost in translation. Are you ready to find out if you are a hunter, a sniper, a stalker, or an investor? Let's break down the 4 archetypes of trading strategies. To choose a strategy without defining your time horizon is like trying to build a house without knowing if it is a bungalow or a skyscraper. The materials are the same, bricks and mortar, or in our case, candles and volume, but the engineering required is fundamentally different. In the world of professional Forex trading, your time horizon dictates your lifestyle, your risk exposure, and the specific mathematical edge you are trying to exploit. Let's dissect the 4 distinct tribes, starting with the most adrenaline-fueled and often the most misunderstood: the scalper. The scalper lives in the microscopic noise of the market. Their battlefield is the 1-minute M1 and 5-minute M5 charts. If you are a scalper, you are not looking for a trend that lasts all day. You are looking for a reaction that lasts seconds or minutes. You are a high-frequency operator. A scalper might aim to snatch 3 to 5 pips of profit 10 times a day. Imagine a scenario where the US dollar spikes up on a minor news release. The scalper does not care why it spiked. They see the momentum, they see the order flow on the level 2 data, and they click buy. 2 minutes later, as the momentum fades, they sell. They are in and out before most traders even realize the price moved. However, the educational overview reality check here is brutal. Scalping is arguably the most difficult style to master because the mathematics work against you. Remember the spread. The commission you pay the broker? If the spread is 1 pip, and you are targeting 3 pips of profit, you have to clear the market friction by 33% just to break even. A scalper must have an incredibly high win rate, often upwards of 70%, to be profitable because their winners are tiny compared to their transaction costs. Furthermore, this style requires intense concentration. You cannot blink. You cannot go to the bathroom. One sudden spike against you can wipe out the profits of 10 successful scalps if your stop loss is not automatic. This is not investing. This is high-speed combat. Moving up the time frame ladder, we find the day trader. This is the archetype most people envision when they think of a professional trader. The day trader's golden rule is simple: flat by 5. This means they never, under any circumstances, hold a trade overnight. When the New York session closes, their account is all cash. The psychological benefit of this cannot be overstated. The day trader sleeps soundly. They do not worry about a surprise geopolitical event in the middle of the night causing the market to gap against them. They operate primarily on the 15-minute M15 and 1-hour H1 charts. They are looking to capture the daily range. If the average daily range ADR of the pound sterling to US dollar is 100 pips, the day trader wants to capture a slice of that, perhaps 30 to 50 pips. Case studies suggest that day trading offers a balanced compromise. You have enough time to make calculated decisions, unlike the scalper, but you get frequent feedback and opportunities, unlike the longer-term styles. However, it still requires a significant time commitment. You generally need to be present during the volatile overlap sessions we discussed in Part 5. You are essentially treating trading as a shift work job. Now let's speak to the swing trader. This is the stalker. If you have a full-time job, a family, or simply do not want to stare at a screen for 4 hours straight, this is likely your tribe. The swing trader operates on the 4-hour, H4, and daily, D1 charts. They are not interested in the noise of the day. They are hunting for the multi-day moves. Imagine seeing a trend developing on the euro. The swing trader analyzes the chart on Sunday night. They see a setup forming. They place a limit order to enter if the price hits a certain level. They set a wide stop loss and a large take profit target. Then they go to work on Monday morning. They might check their phone once a day. The trade triggers on Tuesday. It fluctuates up and down. The scalper would have panicked 5 times by now. The swing trader does nothing. They hold through the noise. By Thursday, the trade hits the target, capturing 200 pips. The math for a swing trader is different. Because they target larger moves, the spread transaction cost becomes negligible. Paying 2 pips to make 200 is irrelevant. However, they face a different cost. Swap fees. If you hold a trade overnight, you either pay or receive interest based on the currency rates. If you are shorting a high-interest currency, the broker charges you a fee every night. A swing trader must account for this carrying cost. Furthermore, they must have nerves of steel to endure retracements. Seeing your open profit drop from $500 down to $200 before going back up requires a deep trust in your analysis that most beginners lack. Finally, at the top of the food chain, sits the position trader, or the investor. These are the whales. They look at weekly and monthly charts. They are trading macroeconomic divergences that take months or even years to play out. Consider the carry trade example regarding the Japanese yen we touched on earlier. A position trader identified in 2022 that the US Federal Reserve was raising rates while Japan was not. They bought US dollar to Japanese yen and held it for 18 months. They did not care about the daily news. They did not care about non-farm payrolls. They were riding a tectonic shift in the global economy. Position trading requires the least amount of screen time, perhaps 1 hour a week, but the deepest understanding of fundamental analysis. Technicals are used only for timing. Fundamentals drive the decision. The downside? You need significant capital to withstand the massive swings of a weekly chart without getting a margin call. Your account must be substantial and your leverage very low. The catastrophe happens when a trader suffers from style drift. This is a common psychological trap. Imagine you enter a trade as a scalper. You want 10 pips. The market moves against you by 20 pips. Instead of taking the loss, you say, "I'll just hold it." It looks like a good swing trade setup on the hourly chart. You have just shifted your archetype to avoid pain. You are now a scalper holding a swing trade with a scalper's position size. This is fatal. You are applying the rules of one game to another. A swing trade requires a wide stop loss. If you hold a scalp trade, which often has large lot sizes, with a swing stop loss, you will blow your account. You must pick a lane. You must declare, "I am a swing trader. I trade the H4 chart. I do not look at the M1 chart because it is irrelevant noise to me." This discipline filters out 90% of the confusing information the market throws at you. So let's review. We have the machinery. We have the edge, the risk parameters, the psychology, the market timing, and the time horizon. You have all the components of a strategy scattered on the floor of your mind. But components do not make a car. You need to assemble them into a cohesive, drivable vehicle. You need a document. This is the part that separates the hobbyist from the CEO of their own trading business. Professional traders do not keep their strategy in their heads. They have a trading plan, a physical written document that dictates their entire operation. It is their constitution. It is their law. If it is not in the plan, they do not do it. Most beginners have never seen a real institutional trading plan. They think it's just a sticky note that says buy low, sell high. It is not. It is a comprehensive manual that covers everything from your morning routine to your disaster protocols. We are about to construct this document together. We are going to write the standard operating procedure, SOP, that you will theoretically sign before you ever execute another trade. This document is the difference between feeling like a trader and being a trader. Are you ready to draft the contract that will govern your financial future? The trading plan is not a wish list. It is a binding legal contract between you, the employee, and you, the CEO. When you sit down at your desk, you are the employee. Your job is not to think. Your job is to execute the orders given by the CEO. The CEO is you, but in your cold state. On the weekend, calm, rational, and looking at the data. If the employee starts improvising, the CEO must fire them. This document is the only thing that keeps the employee in line. Let's construct this standard operating procedure, SOP, section by section. A professional trading plan has 5 distinct chapters. Chapter 1 is the pre-market ritual. Before you ever look at a chart, you must check the red folder news events. In the US, this means knowing exactly when the Federal Reserve Chairman is speaking, or when the Consumer Price Index (CPI) data is released. Case studies show that 50% of catastrophic retail losses occur because a trader was holding a position during a major news spike they didn't know was coming. Your plan must state, I will not open a new trade 30 minutes before or after a high-impact news event. This single rule eliminates the risk of slippage, where market volatility is so high that your stop loss is ignored, and you lose more than you calculated. Furthermore, Chapter 1 includes a biocheck. You must assess your physical and mental state. Professionals often use the acronym HALT. Hungry, angry, lonely, tired. If you are any of these, your cortisol levels are elevated, and your decision-making is compromised. If you check yes to, am I angry about my argument with my spouse? The trading plan dictates, do not trade. It is better to miss an opportunity than to lose capital because you were emotionally compromised. Chapter 2 is the setup criteria. This is the core technical definitions we discussed in previous parts, but now they must be written as binary, if/then statements. Ambiguity is the enemy. You cannot write, I will buy when the trend looks strong. That is subjective. Strong is a feeling, not a metric. Instead, your plan must say, if the price is above the daily 50 EMA, condition A, and the price pulls back to the hourly support zone, condition B, and a bullish engulfing candle closes on the 15-minute chart, condition C, then I will place a buy order. Notice the capitalization of and. All conditions must be met. If you have A and B but not C, you do nothing. You sit on your hands. This prevents boredom trading. A systematic trader might look at the markets for 4 hours and do absolutely nothing because the checklist was not complete. To the amateur, this looks like wasted time. To the professional, this is successful risk management. Chapter 3 is the risk protocol. This dictates the math. Your plan must explicitly state your risk per trade. For example, I will risk exactly 1% of my current account balance per trade. It must also define your max daily loss. This is your circuit breaker. Imagine a scenario where you lose 3 trades in a row in the morning session. You are down 3%. You are frustrated. The temptation to revenge trade and increase your size to make it back is overwhelming. Your trading plan saves you here. It should state, if I lose 3% in a single day, I must shut down the trading terminal and walk away until tomorrow. This rule acknowledges that either the market conditions are not aligned with your strategy, or your head is not in the right place. By mechanically forcing a stop, you live to fight another day. Without this rule, a bad morning turns into a blown account by the afternoon. Chapter 4 is the trade management rules. This describes what you do after the entry. This is where most emotional mistakes happen. The market moves in your favor, and you get scared it will reverse, so you close early. Or it moves against you and you move your stop loss further away. Your plan must rigidly define your management triggers. For example, I will move my stop loss to break even only after the price has moved 1 unit of risk, in my favor. Or, I will take 50% of the profit off the table at 2R, and let the rest run to 3R. By predefining these actions, you remove the decision fatigue. You are not deciding what to do with a live grenade in your hand. You are simply following the disposal procedure you wrote when you were safe. Chapter 5 is the post-trade review. This is the feedback loop. The plan must require you to screenshot every single trade, win or loss, and categorize it. Was it a valid win, followed rules, made money? Was it a valid loss, followed rules, lost money? Was it an invalid win, broke rules, got lucky? Or was it an invalid loss, broke rules, lost money? In the eyes of a professional, an invalid win is the most dangerous outcome. It reinforces bad behavior. It teaches your brain that breaking the rules gets rewarded. Your trading plan should include a penalty for invalid wins, such as forcing you to reduce your position size by half for the next week to earn your way back to full size. Let's look at a comparative case study to see this document in action. Imagine two traders, Mike and Jessica. Both see the same setup on the US dollar to Canadian dollar. Mike has no written plan. He sees the price dropping and thinks, "This looks like it's bottoming out." He buys. He doesn't calculate his position size. He just clicks one lot. The price drops further. He gets nervous. He stares at the screen, sweating. He decides to buy more to lower his average entry. The news comes out, Canadian unemployment data, which he forgot to check. The price plummets. Mike panics and closes everything for a massive loss, ruining his month. Jessica has her SOP. She opens her plan. Step 1, check news. She sees the CAD data release in 20 minutes. Her rule says, no new trades 30 minutes before high-impact news. She closes the chart. She misses the trade. She misses the loss. She preserves her capital. 2 hours later, after the volatility settles, the market presents a clear Type 2 reversal. She checks her conditions. A, B, and C are present. She calculates her risk to be exactly 1%. She enters. She sets her targets. She walks away to make coffee. She comes back to find her take profit hit. Mike was gambling on a hunch. Jessica was executing a business process. The difference was not intelligence. The difference was the document. But here is the catch. You can write the most beautiful detailed trading plan in the world. You can have it laminated and framed on your wall. But how do you know if the strategy written inside it actually makes money? How do you know that condition A, B, and C actually has a positive expectancy? What if your strategy, even when followed perfectly, is a losing strategy? You cannot risk real money to find out. That would be financial suicide. You need a way to travel back in time. You need to simulate thousands of trades over years of historical data to prove that your edge is real before you risk a single cent of your hard-earned savings. Most beginners skip this step because it is tedious. They want the excitement of live trading. But the professionals know that this next phase is where the fortune is actually made. The confidence to pull the trigger with real money does not come from belief. It comes from evidence. We are about to enter the laboratory. We are going to take your newly written trading plan and put it through the stress test of the past decade. Are you ready to learn the scientific method of backtesting that predicts your future performance? You have built the engine. You have written the manual. You have trained the driver. Now, before you take this vehicle onto the highway at 100 miles per hour, you must put it in the wind tunnel. You must verify that it will not disintegrate under pressure. This process is called backtesting, and it is the scientific backbone of any professional Forex trading strategy. Without it, you are operating on faith. With it, you are operating on data. Most retail traders treat the market like a casino. They just want to play. Professionals treat the market like a laboratory. The goal of backtesting is not just to see how much money I would have made. The goal is to deconstruct the statistical personality of your strategy. You need to know its flaws, its breaking points, and its ugliest moments before they happen to you in real life with real capital. So, how do we perform a professional-grade backtest? It is not merely scrolling back through a chart and saying, "Oh yeah, I would have bought there." That is a delusion known as hindsight bias. When you look at a completed chart, the winning trades jump out at you, and your brain conveniently ignores the messy, choppy periods where you would have lost money. To do this correctly, you need simulation software. Platforms like TradingView or dedicated tools like Forex Tester allow you to use bar replay mode. This tool allows you to travel back in time. Let's say to January 1st, 2019. It hides all future price action. You press play, and the candles start printing one by one, just as they would in a live market. You sit there watching the price unfold. You see a setup that matches the criteria in your trading plan, Chapter 2. You pause the simulation. You calculate your position size based on your risk parameters, Chapter 3. You enter the trade in a spreadsheet, your backtesting log. You record the entry price, the stop loss, and the take profit. Then you press play again. You watch the trade play out. You record the result. Then you wait for the next setup. You do not do this 10 times. You do not do this 50 times. To have any statistical significance, you must do this a minimum of 100 times. Ideally, 300 to 500 times across different market conditions. During the COVID crash of 2020, the quiet markets of 2018, and the trending markets of 2021. You need to see how your strategy handles war, peace, recession, and boom. Once you have this dataset, you move from the data collection phase to the data analysis phase. You are looking for specific key performance indicators, KPIs, that will tell you if this business is viable. The first number everyone looks at is win rate. I win 60% of the time. But as we discussed in part 2, win rate is vanity. The more important metric is profit factor. This is calculated by dividing your gross profit by your gross loss. If your strategy made $10,000 in winning trades and lost $5,000 in losing trades, your profit factor is 2.0. This is an excellent number. It means for every dollar you lose, you make 2. A profit factor below 1.0 means you have a losing strategy. A profit factor between 1.2 and 1.5 is a workable grinding strategy. Anything above 2.0 is considered elite. However, there is a dark metric that is even more critical than profit factor. It is called maximum drawdown. In your simulation of 500 trades, find the period where you performed the worst. What was the peak to valley drop in your account balance? Did you lose 20%? 30%? This number is your pain threshold. If your backtest shows a maximum drawdown of 40%, you have to look yourself in the mirror and ask, if I lost 40% of my life savings in 2 months, would I keep trading? Most people would say no. They would quit, assume the strategy is broken, and stop just before the recovery began. If the maximum drawdown in your backtest is higher than your psychological tolerance, the strategy has failed, even if it ends up profitable in the long run. You must tweak your risk parameters to reduce that drawdown to a survivable level. Now we must address the most dangerous trap in backtesting: curve fitting or over-optimization. Imagine you run your backtest and the results are okay but not great. You think, if I change my stop loss from 20 pips to 15 pips, I would have avoided these 5 losses. You change the rule. You run the test again. The results look amazing. Then you think, if I add a rule that I only trade on Tuesdays, my profit doubles. You make the change. You are crafting a strategy that is perfectly designed to win in the past. But the past never repeats itself exactly. By over-tightening your rules to fit the historical data perfectly, you are creating a fragile strategy that will shatter the moment it meets new, unseen data. This is called curve fitting. A robust strategy is loose enough to handle imperfect variations. If your strategy only works with a stop loss of exactly 17 pips, it is garbage. It should work reasonably well with 15, 17, or 20 pips. Should be robust, not precise. Once your strategy has survived the backtesting phase without being curve fitted, you have a theoretical edge. You have proven that, in the past, this plan made money. Now, you must prove it can make money in the present. This is the phase of forward testing, or paper trading. You open a demo account with a broker. This account uses real live data, real spreads, and real market hours, but the money is fake. You treat this account exactly like real money. You execute your plan for 2 to 3 months live. Why is this necessary if the backtest was successful? Because backtesting removes the element of life. In a backtest, you can fast forward through the boring parts. In live trading, you have to wait. You have to deal with fatigue. You have to deal with the distraction of your day job. You have to deal with slippage, where the broker fills you at a worse price than you wanted because the market is moving too fast. Backtesting software rarely simulates slippage accurately. Forward testing is the bridge between theory and reality. It exposes the operational friction of your strategy. You might find that your strategy requires you to wake up at 3 a.m. for the London Open, and after 2 weeks of forward testing, you realize you are too exhausted to function. The strategy works mathematically, but it fails biologically. It is better to find this out in a demo account than to lose your job and your savings trying to force it. During this forward testing phase, you are also building muscle memory. You are training your brain to recognize the setup in real time. You are training your fingers to calculate the lot size and place the order without fumbling. You are debugging your own performance. If after 3 months of forward testing your equity curve is trending up, and your stats, win rate, profit factor, drawdown, align with your backtest results, you have achieved something that 99% of people never achieve. You have a verified, validated, robust business plan. You have proof of concept. But now you face the final towering wall. The one that has nothing to do with charts and everything to do with resources. You have a strategy that can turn $1 into $1.20. That is a 20% return. That is phenomenal. But if you only have $1,000 in your savings account, a 20% return is $200. You cannot live on $200. You cannot quit your job on $200. The math of retail capital is depressing. To make a full-time income of $50,000 a year with a conservative 20% return, you need a starting capital of $250,000. Most people do not have $250,000 lying around. This leads many traders to crank up their leverage, take insane risks to turn $1,000 into $50,000, and inevitably blow up. But what if I told you that in the modern era of Forex trading, you do not need your own money? What if I told you that if you can prove you can trade using the data and records you just generated in your backtesting and forward testing, there are companies waiting to hand you accounts worth $100,000, $200,000, or even $500,000 to trade with? This is the revolution of proprietary trading. It is the scaling mechanism that turns a skill into a career. But getting funded is not easy. It is a test, a gauntlet designed to weed out the lucky from the skilled. Are you ready to learn how to take your proven strategy and access the capital of the big leagues? The barrier to entry in financial markets used to be wealth. In the 1980s and 1990s, to sit at a trading desk and access institutional leverage, you needed to be hired by a major bank on Wall Street or in the City of London. You needed an Ivy League degree, the right connections, and a suit. If you were a retail trader, you were isolated, trading with whatever scraps of savings you could scrape together. But the digitization of finance has created a new ecosystem known as proprietary trading firms, or prop firms. Here is the value proposition. If you can prove you have the edge, Part 2, the risk management, Part 3, and the psychology, Part 4, to extract profit from the market consistently, these firms will allocate their capital to you. We are talking about accounts ranging from $10,000 up to $1 million or more. In exchange, you keep a significant split of the profits, often between 70 and 90%, while they take a small percentage and cover the downside risk. This sounds like a utopia, but we must apply the same critical lens here that we applied to technical analysis. This is a business arrangement, not a charity. To access this capital, you must pass the evaluation. This is the ultimate stress test of the trading plan you wrote in Part 8. The evaluation typically consists of two phases. Phase 1 is the challenge. You are given a demo account with strict rules. You might be required to generate a profit of 8 or 10% within a certain time frame, usually 30 days. But here is the catch, and here is where the amateur fails. You must achieve this aggressive target without violating a strict maximum drawdown rule. Most firms have a daily loss limit, often set at 5% of the account equity, and a total loss limit, often set at 10%. If at any moment during the trading day, your floating equity drops by 5%, the account is breached. You fail. Game over. The fee you paid to take the test is forfeited. This changes the mathematics of your strategy entirely. If you were risking 2% per trade in your personal account, losing 2 trades in a single day puts you at 4% drawdown, dangerously close to the 5% limit. The pressure is immense. Therefore, a professional strategy adapted for a prop firm often requires you to quarter your risk. You might have to risk 0.5% per trade. This means you need to be hyper-accurate. You cannot just spray and pray. Let's imagine a scenario to illustrate the prop firm trap. Trader A is talented. He has a strategy with a 60% win rate. He pays $500 to take a challenge for a $100,000 account. He starts trading. On day 1, he loses 1%. On day 2, he loses another 1%. He is down $2,000. His psychology cracks, Part 4. He feels the time pressure of the 30-day limit. He decides to size up to catch up. He risks 3% on a sure thing. The market spikes against him. He hits the daily loss limit. He is out. Now look at Trader B. She uses the exact same strategy, but she understands that the prop firm's business model relies on impatient traders failing the evaluation fees. She refuses to be the product. She wants to be the partner. She calculates that to hit 10% profit, while risking only 0.5% per trade, requires a sequence of high-quality setups. She ignores the 30-day timer. She trades her plan. She finishes the month up only 4%. She didn't hit the target. However, because she was profitable and followed the rules, most reputable firms will offer a free retake. She extends her timeline. She passes phase 1 in 2 months. She passes phase 2 verification in another month. Trader B is now funded. She has access to $100,000 of capital. Now the math of her life changes. A conservative return of 3% a month, which is very achievable for a swing trader, is $3,000. That is a secondary income stream. If she scales that to a $300,000 allocation, that is $9,000 a month. She is doing the exact same work, looking at the exact same charts, taking the exact same trades as the trader with the $1,000 account. The only difference is the leverage applied to her decision-making. But this is where the final danger lies. The payout psychology. When you are trading a demo account or a small personal account, the numbers are abstract. When you are funded and you see a trade go against you by $1,000 in 10 minutes, your amygdala screams. Feels like you just lost a mortgage payment. This is why many traders pass the evaluation but lose the funded account within the first week. They suffer from imposter syndrome. They do not believe they belong at that level. To survive as a professional strategist, you must treat the funded account exactly like the test. You must hide the dollar amount on your terminal and look only at percentages or pips. You must detach from the money. The money is just a scorecard. The moment you start calculating what you can buy with the open profit on your screen, you have already lost the trade. We have now traversed the entire landscape of the Forex trading strategy. We started on the edge of the cliff, looking at the chaos of the market. We built the 3 pillars: edge, risk management, and psychology. We analyzed the sessions, the pairs, and the market structure. We defined your tribe, scalper, day trader, or swing trader. We wrote the standard operating procedure. We stress tested it with backtesting. And finally, we looked at the vehicle for scaling through prop firms. You now understand that a strategy is not a single line on a chart. It is a mechanical system of gears working in unison. If one gear breaks, if you have the edge but no risk management, or the risk management but no psychology, the entire machine stops. There is no secret sauce. There is no indicator that turns red to make you rich. The banks do not have a secret manual that you don't. They simply have strict adherence to probability and risk control. The holy grail of trading is not an external tool. It is internal discipline. It is the ability to do the same boring thing over and over again when everyone else is running around trying to get rich quick. Forex trading is the hardest way to make easy money. It requires you to master yourself before you can master the charts. It demands that you become a data analyst, a risk manager, and a psychologist all at once. But if you respect the process, if you treat this not as a casino but as a high-performance business, the potential outcomes are limitless. The journey does not end here. In fact, the education never ends. The market is a living, breathing entity that evolves. The strategies that worked in 2010 stopped working in 2015. The strategies of today may need to adapt by tomorrow. Professional is always a student. You have the map. You have the compass. The ocean is waiting. This concludes our 10-part deep dive into the anatomy of a Forex trading strategy. If you are ready to take the next specific step, perhaps seeing a live breakdown of a backtesting session or a real-time analysis of market structure, you know where to look. The charts are open. Good luck.